Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 6th of May. I'm Daniel Lam, your host for the podcast. Yesterday was a public holiday in Hong Kong, celebrating the Buddha's birthday. Now, on this date of supposedly peacefulness, came a somewhat eventful news, again from Donald Trump, that he will be imposing 100% tariff on foreign-made movies. And to me, a movie buff, this cannot be a positive piece of news. Nonetheless, the market is taking this quite alright, because movie is not as essential an item as the others that Trump had already put tariff on. Now, like we talked about yesterday, the next 100 days in Trump 2.0 is likely to see trade deals being made with key trading partners, and markets continue to be giving the benefit of the doubt, with calmer equities and stabilizing bond yields. Now remember that Trump's priority is to control the US budget deficit, and driving down the bond yield is an integral part of this. Now in recent months, the US 10-year government bond yield has traded within the 4% to 4.5% range. We previously advocated adding to high-quality US dollar bonds when yields rebound towards the high end of this range and above our 4% to 4.25% forecast. And we would like to reiterate this strategy here. Well, assuming no resurgence of inflation worries, it is likely that the 10-year bond yield retests the 4% level in the very short term. But at such levels, we would be cautious about increasing exposure significantly. Why is that? Well, we believe that in the near term, yields remain vulnerable to upward pressure, driven by unresolved trade negotiations, the risk of any new technical stress in bond markets, and the risk of any resurgence in inflation pressures. It will be much more likely that 2-year and 10-year US government bond yield rebounding back above 3.95 and 4.25% respectively, which we would view as more attractive levels to add exposure. At those levels, there will be some cushion for investors. Longer term, we stay overweight DM investment-grade government bonds and target an average maturity profile of 5 to 7 years. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.